Warren Buffett, often referred to as the Oracle of Omaha, is one of the most successful and well-known investors of our time. His time-tested principles of investing have guided countless individuals and professionals in their pursuit of financial success. Here are Warren Buffett's 5 rules of investing. Number 1, never lose money. Warren Buffett's principle of never lose money sums up his emphasis on protecting capital and minimizing risk. To quote Buffett, rule number 1, never lose money. Rule number 2, never forget rule number 1. This rule has less to do with the fluctuations in the market and more to do with the character or temperament an investor needs to have. It does not mean that you will not face a loss. After all, even Buffett is not immune to losses. In fact, according to an article on Investopedia, Warren Buffett's Berkshire Hathaway reported a net loss of $22.8 billion in 2022 due to market volatility. Buffett's advice simply means when investing, don't go into it with a cavalier attitude that it's okay to lose. Instead, focus on really doing your homework before starting any kind of investing. Don't make financial decisions without knowing what you're getting into. Buffett invests only in companies he has thoroughly researched and understands. Buffett also maintains quite a frugal lifestyle for the amount of wealth he has accumulated. He continues to live in the same modest home in Omaha that he purchased in 1958 for just $31,500 and regularly picks up McDonald's for breakfast. He remains mindful of the best ways to put his money to work, rather than inflating his lifestyle. Number 2, never invest in a business you don't understand. Warren Buffett has been famously quoted saying, "Never invest in a business you can't understand." Using this rule, he tells investors to focus on protecting their investments by choosing companies or businesses that they have in-depth knowledge of. While you can find a company or business that appears to be very lucrative, it is reckless to invest in them if you don't fully understand what the company or business's primary goals are. Buffett has been very vocal about never investing in things like cryptocurrency. In a recent Berkshire Hathaway shareholders meeting, Buffett gave his thoughts about Bitcoin in this CNBC video.
Now, if you told me you owned all of the Bitcoin in the world and you offered it to me for $25, I wouldn't take it because what would I do with it? I have to sell it back to you one way or another. I mean, they have the same people, but it isn't going to do anything. The apartments are going to produce rental and the farms are going to produce food. And if I've got all the Bitcoin, I'm back where whatever his name was, who may or may not have existed, was 15 years ago. If I've got it all, he could create a mystery about it. But everybody knows what I'm like. I mean, so if I'm trying to get rid of it, people will say, well, why should I buy some Bitcoin from you? I mean, why don't you call it Buffett coin? Make your own or something. What? Do something. But I'm not going to give you anything for it. And you'd be right, incidentally. But that explains the difference between productive assets and something that depends on the next guy paying you more than the last guy got. Now,
whether we agree or disagree with him on his views regarding Bitcoin, this is an example of him choosing to stick to things he understands, like undervalued businesses that have a track record of success. To quote him again, "I get in enough trouble with things I think I know something about. Why in the world should I take a long or short position in something I don't know anything about?" While investing in general can be risky, according to Buffett, risk comes from not knowing what you are doing. Buffett's emphasis is on investing in businesses with a clear and sustainable competitive advantage that will be around for a long time, making him money. Number 3, hold investments for the long term. Warren Buffett's principle of holding investments for a long time reflects his belief in the benefits of long-term thinking. As an example, he bought his first shares of Coca-Cola in 1988 and made it one of Berkshire Hathaway's largest holdings. Today, his company is still one of the largest shareholders of Coca-Cola, with a stake of 9.2%. His advice when investing in stocks is to be long-term minded, rather than chasing quick profits. He states, "If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes." With any kind of investment, there will be ups and downs, and investing from an emotional perspective can lead to making poor decisions like panicking and selling your investments at the wrong time. When investing in a company, Buffett advises, only buy something that you'd be happy to hold if the market shut down for 10 years. This means that by understanding and believing in a company's long-term future potential, only then should you go ahead and invest in it. If you can't see yourself holding that company's stock for 10 years, and the stock market were to shut down for the 10 years and you couldn't sell the stock, then don't invest in it. Only if you are willing to hold a stock for 10 years or more should you put your money into it. Buffett's focus has been on investing in strong, stable businesses that have the potential to generate consistent returns over the years. Number 4, don't invest with borrowed money. Warren Buffett advises against using leverage or borrowed funds to invest, as it magnifies both gains and losses, potentially leading to significant financial instability. To quote Buffett, "I've seen more people fail because of liquor and leverage being borrowed money. I've never borrowed a significant amount of money in my life. Never will. I've got no interest in it." The biggest concern with using debt to buy investments like stock is, no one is immune to market fluctuations. There may be times when you see a stock doing so well that borrowing and investing in it seems like the right thing to do. Even though a stock might be doing well at the moment, its value can come crashing down and land you in debt if you bought it with borrowed money. When you buy stocks on borrowed money, your focus will likely be on returning the money rather than creating a long-term strategy of investing. To emphasize this point, Buffett states, even if your borrowings are small and your positions aren't immediately threatened by the plunging market, your mind may well become rattled by scary headlines and breathless commentary, and an unsettled mind will not make good decisions. His approach encourages responsible and sustainable investing, focusing on using one's own resources and avoiding unnecessary exposure to market fluctuations. Number 5, be fearful when others are greedy. Warren Buffett's principle of being fearful when others are greedy and greedy when others are fearful defines his contrarian approach to investing. He advises investors to resist following the crowd's emotional reactions and instead seize opportunities that arise when market sentiment is extreme. By buying when others are fearful and in a panic, and selling when others are being greedy, investors can capitalize on under- or overvalued assets and potential market reversals. His advice here is to avoid following the herd when it comes to investment decisions. To become a successful investor, you need to rely on your own experience in the market. When a lot of investors think positively about a particular stock, the prices tend to inflate and become overpriced. By investing at inflated prices, you overpay for the investment and limit your returns. The opposite is true when many investors are largely negative about a stock and it becomes undervalued, creating an opportunity to buy at bargain prices. It is important to note here that you shouldn't try to be different for the sake of being different. Buffett's experiences should teach you that investing requires continuous learning, and that it comes down to taking informed risks when choosing which companies to invest in. Research the stock you want to invest in thoroughly and rely on your own judgment to make investing decisions rather than following the popular opinion of the day. Warren Buffett's timeless rules of investing serve as a roadmap for achieving success in the world of investing. His legacy as the Oracle of Omaha continues to inspire individuals and professionals alike to approach investing with a strategic and a long-term mindset. These rules not only reflect the wisdom of one of the world's greatest investors, but also offer a blueprint for building enduring wealth and prosperity. Comment below which one of Buffett's rules of investing you agree with. Watch this video on Warren Buffett's top 10 rules for success. Like the video and subscribe. Thank you for watching.